Brilliant Minds in Real Estate is a mini podcast series that brings illuminating interviews with today's most relevant and motivating leaders throughout all corners of the real estate investment sector. I am Suraj and I work with capital markets at JLL in Dubai. My special guest is Mohamed Ali, Executive Director at NBK Capital Partners. The firm is an alternative investment management unit of NBK Capital and is a leading investment manager in the MENA region across multiple asset classes, including private equity, private credit, and real estate. It is a fully owned subsidiary of National Bank of Kuwait, one of the largest and most prominent banks in the Middle East. It is advised on investments over $1 billion and has a track record of 18 realizations from 29 investments, one of the highest number of profitable exits over the past decade by an alternatives investment firm in the region. Mohamed started his career as a credit risk analyst under the fixed income and investment banking unit of Gulf International Bank and has since shifted his focus to real estate, working with well-known investment firms such as Ark Capital Bank and PineBridge Investments. He is also a member of the firm's Real Estate Investment Committee. Mohamed, welcome to the first ever episode of Brilliant Minds in Real Estate.
Thank you, Suraj. I'm honored to be here and speak with you today.
Let's start at the beginning. In the early 2000s, you were studying at Imperial College of London, doing your master's in electrical and electronics engineering. How did you end up walking into your first job in banking?
The general theme for every growth opportunity that I've had in my career starts with the leader that knows that I, as a candidate, am not a complete fit for the role they had in mind. But that person decides to take a risk of me, holding out a helping hand and coaching me through the journey. And that's true of every single organization that you mentioned earlier. So in 2003, the penultimate year of university, there was a big buzz around engineering students applying to McKinsey, Booz Allen, JP Morgan, Barclays Capital. I got curious about finance and consulting, and I applied for an internship at GIB in Bahrain. I was too late, the program was full, but they did ask me to interview with them for a full-time role the following year.
So Mohamed, you're a certified FRM. Do you recommend FRM and other similar certifications such as the KAYA or the CFA for investment professionals, especially those coming from non-banking backgrounds?
Wholeheartedly, yes. Highly recommend them and believe they are essential for non-finance majors. NBK Capital has been a big supporter of the CFA Institute. And in the words of our Chief Executive, Faisal Hamid, we consider that we share the responsibility of supporting excellence and professionalism in the industry.
Mohamed, so I happen to have a civil engineering degree and my dad's been in the real estate game for as long as I can remember. So real estate capital markets and JLL was quite a natural transition. What made you make the move from fixed income and risk in a bank to real estate?
The push came from the disaster that was the global financial crisis and the havoc that was unleashed by the proverbial pizza delivery guy in Minnesota defaulting on his subprime mortgage and in turn sending shockwaves through the global financial system. It wasn't just plain fixed income that we were investing in, but we had a mountain of CDOs and mortgage-backed securities. Those were hit hard. So after 6 years of being a desk jockey, working with abstract structured products and derivatives in global markets, I questioned what real value we were creating for our own economies in the GCC, for our investors, and whether or not we really had an edge. At the same time, a friend called and asked if I was interested in a role where we invested in simpler asset classes closer to home, in a strategy that made a positive impact on our economies, and of course that I'd be getting a lot of sunshine and travel out of the office. Sign me up, I said.
I think sunshine, especially in our part of the world, is not something that we're worried about. Mohamed, we chat often about your firm's investment strategy through the deals that JLL takes to market, and the underlying theme has always been long-term leases with good governance. Can you talk a little bit more about your acquisition philosophy and shed some light on the deals that you've closed in the recent past?
Sure. If you start by holding up the coin that is NBK Capital Partners, on the one side, our role is to provide our investors with access to attractive alternative investment products in the MENA region, often with current yield, always with upside returns and downside protections. Flip that coin, and we see our role to our portfolio companies as providers of long-term capital that empowers those management teams and shareholders to achieve their growth objectives. The instruments that we use are either injecting new capital using a very involved and intensive private equity investment, or a less immersed but still very intimate private credit investment, or by releasing existing equity locked in a company's operating real estate assets through sale and leasebacks. We have a top-down approach that first underwrites the sectors that we'd like to invest in. It moves on to underwrite the credit worthiness and growth prospects of the company or the lessee. And finally, we underwrite the real estate asset itself. So we don't start with the real estate, but we underwrite it last. In that sense, NBK Capital Partners, with its heritage of investing in regional private equity and regional private credit, is the perfect house for this real estate strategy. The thing is, the synergy that exists between our three disciplines is priceless. My partner Hisham and I have worked together at a few different firms for 10 years now. Together, we've deployed about $600 million into triple net long leased assets across the GCC, predominantly in Saudi Arabia, the United Arab Emirates, and Oman. Out of 10 investments, 9 have been fully exited. These assets include a couple of K-12 education campuses in Dubai, 2 FMCG logistics assets in Oman and Saudi Arabia, plus a couple of master leased community retail assets in Saudi Arabia as well.
That's very fascinating. And I do know some of the deals that you were talking about earlier. Now let's talk about something that's near and dear to both of us: sale and leasebacks. When an owner of a property decides to sell the property and leases it back from the buyer, many companies typically use this as a tool to help free up capital for various purposes. This isn't a novel concept by any means, but COVID-19 has really left many companies with substantial liquidity concerns and has reignited sale and leaseback interest among both buyers and sellers. What's your take on sale and leasebacks becoming more popular, and how do you go about avoiding events of default by these same companies who may continue to face liquidity issues in the future?
You're right. The concept has now become mainstream in the GCC and grown in popularity over the past decade, in no small part due to the early and continued work of the JLL Capital Markets team in educating asset owners about the viability of sale leasebacks as a long-term solution to finance their growth strategies. When you compare a sale leaseback to a bank loan, a lot of asset owners initially balk at the pricing. They say, what? I'm going to borrow money from you, or I'm going to pay you a yield of around 9% on my asset. I can borrow from banks at 3.5% or 4%. They compare the interest rate or the profit payment on their facilities to the yield that they pay on sale leasebacks, when there is that hidden element of amortization in the bank loans. When you add up the profit or the interest component and the amortization, even on a 7-year straight line loan, you start hitting cash outflows in the middle to high teens. When in a sale leaseback, yield or the cash outflow stays constant at around 9 and maybe escalates to the region of 10 or 11% over a 5 to 7 year sale leaseback as these rental amounts escalate. In terms of differentiating between good credits and questionable credits, and we see that a lot these days. I mean, we talked about it earlier that we have to do a lot more intensive filtering now. The frequency and the number of deals has increased, but the quality not necessarily so. Like the title of that book by Simon Sinek, we start with why. If the lessee is distressed and needs cash as an injection and is to solve a short-term problem, it's a non-starter for us at any price. The yield could be 10, could be 15%. Deals that pass our first filter are those where the seller is paying down debt, investing in capex, acquisitions, and capturing market share using the sale proceeds. So the sale leaseback and the capital that's unlocked from that real estate is making them a better credit for us and a better covenant and better lessee day by day. Another quick test we do is how mission critical the asset is for the lessee. A couple of years ago, when one of the larger FMCG retailers in the region offered us a look at their entire real estate portfolio, we immediately dismissed their office building. They could move to another one. It's not mission critical. They could build another one. They're not stuck to it. And that's not where they generate their revenue. We then took a glance at their supermarkets and skipped those two straight to their central warehouse, the beating heart of their operation and the feeder for all of their 20 plus locations. Defaulting on the rent or renegotiating the rent on that asset would be the last thing they do. And this crisis has shown the resiliency of mission critical assets and rentals on mission critical assets being paid on time when it comes to lessees that have witnessed a degree of distress.
Talking about distress and talking about the current economic climate, everybody has a story to tell about economic disasters. Everybody has a story about what was going on in their firm during the global financial crisis. Tell us what was going on in your head then, and how do you think the current situation compares to 2008, 2009?
Like I am today, I was privileged to be in the company of seasoned bankers and investment professionals. It was not, and today it is not, the first crisis. So after a couple of days of me yo-yoing between denial and heightened anxiety, I started noticing and taking lead from what my bosses were doing. They were, as the leaders at NBK Capital are now, calm, over-communicating with their teams, and purposeful in their actions. Every firm has a crisis management playbook, but in abstract, ours is to first take stock of the impact on our existing portfolio and stress assets that are performing and unaffected as yet. We then report and communicate clearly with governance layers and stakeholders, be it the investment committee, board of directors, or anchor investors. We need to be clear and decisive. The worst thing you could do is kick the can down the road. We then immediately take action to safeguard the equity, whether that means talking to your bankers, your tenants, or your investors. Finally, and this is very important to us, and I've seen it in practice in various successful firms, don't be spooked and paralyzed by fear. Continue to be on the lookout for opportunities. Some of the best investment returns across all asset classes have been made right after crises.
I actually agree with a lot of what you're saying in terms of management internally and over communication, which is quite fundamental to not only people within the company but also the investors that you currently have. I read an interesting article about how COVID-19 has really accelerated the transformation of certain real estate asset classes, data centers, healthcare, and logistics getting a lot of the attention while hospitality and retail are left at the bottom of the pile. There seem to be some very good deals in the market for those with the right information. What's your take on pricing real estate in the current market?
Suraj, you're right. I agree with you there. We now find ourselves choosing instead of chasing assets. When it comes to pricing in regional markets, our house view is that sadly there's more pain across most sectors. The past 3 to 4 years have witnessed a tsunami of REIT liquidity that was deployed in haste. It inflated asset values beyond where fundamentals were able to support them. A simple measure is to plot the CAGR of asset prices against the CAGR of rental growth. You'll see that the former dwarfs the latter. Interestingly, the CAGR of construction costs is negative over the same period. It's a good time to build much needed supply in specialist sectors such as data centers and e-commerce fulfillment. The team led by Mohsen Awadi at Dubai South have the right recipe. They're building e-commerce fulfillment centers and have a very strong tenant list. When it comes to existing assets that are income producing, we've seen these reprice down over the past 12 months by as much as 15 to 20%. Entry caps for good credits with strong lease securities are now around the 9% mark and carry a sufficient risk premium.
That's interesting. I, being JLL Capital Markets, being in the market, as I was alluding to earlier before the podcast, is that investors are finding it quite tough to price. And there is a sentiment that they should probably hold off and wait for others to invest before putting in their own money. But it's great to hear that you are still keen on closing deals and have a methodology that works for both you and your investors.
We do, and we have the dry powder to back that up. So any deal that we engage on today, our promise to asset owners is that we will be closing in 60 to 90 days. We are money good.
Speaking about dry powder, your firm clearly has an impressive track record for raising capital and delivering returns to investors. Has this year been a tough year for capital raising? Are you looking to expand your current investor base, or are the existing ones reaching deeper into their pockets?
When has capital raising for regional alternative investments ever been easy? Consistently difficult, but NBK Capital Partners has raised capital consistently. So under the leadership of Yasser Mustafa, we raised $160 million for our second private credit fund in 2017. We then went on to raise another $100 million for our MENA Real Estate fund in 2018. If you look at the frequent data for those years, NBK Capital Partners raised close to half of all the capital raised for MENA alternatives during that period. In the past few years, our firm's objective has been to increase the share of institutional capital and the share of investors from outside of Kuwait. Today, the majority of our investors are institutions as opposed to high net worth individuals. Late last year, we launched our third private credit fund, which has received a lot of interest from investors owing to the great performance of the first and second funds. When the pandemic broke out, our business development team, led by my partner Ziad, quickly geared up for virtual due diligence by investors and their advisors. I can tell you that it's a privilege to have the support and partnership of our investors, who are equally excited by some of the opportunities that are available to us today.
Interesting. In terms of opportunities that are available today, you also sit on the investment committee of NBK Capital, an entity that tends to focus more on international investments in the US, UK, and Europe. Are you seeing a trend of Middle Eastern investors seeking to expand their exposure in more mature and stable markets?
Our global real estate team, that's led by my colleague Hazem, have a track record that spans over a decade. Our mandate is to carefully curate direct real estate investments in the US and Europe in conjunction with our JV partners who manage those assets on the ground. I think that a podcast with Hazem would be very insightful about the subject. My own view is that we continue to see rising demand from Middle Eastern investors for yielding real estate assets in developed markets. This is a continuation of an existing multi-year trend. The notable exceptions are those institutions that have a regional focus and a regional development mandate. That demand is primarily a diversification play, as the core businesses and existing real estate portfolios of these investors are based in the GCC and continue to be affected by the volatility in oil prices and the cautious macroeconomic outlook. However, I don't believe that all asset managers will benefit equally from this demand. Those who either bought the market or had a portfolio focused on higher yielding hospitality, senior living, or grade B offices would have suffered during the strict lockdowns in the first half of the year, and we'll see investors shun them for a period of time.
So Mohammed, we've spoken about asset classes, we've spoken about investment strategies and geographies. Looking over for the next 10 years, post-COVID, where do you see the next disruption in the real estate space?
I don't think there's going to be disruption in an abrupt manner, but a wider adoption of changes that are already taking place. The second thing that I believe in is that changes and evolutions in real estate are derivative and are a reflection of changes that are taking place in other spheres of life, such as e-commerce, autonomous vehicles, focus on environmental protection, ESG, etc. So if we look at classic urban planning, cities are like concentric circles around the core business and government district, the CBD. The CBD core is then surrounded by a ring of prime residential, retail, and hospitality. You can imagine London, you can imagine Manhattan, you can imagine Dubai. In turn, that circle has a wide band of residential zoning around it with entertainment, public amenities, and social infrastructure, where most of the population live, followed by some grade B offices, trade, light industry, and some warehousing. Then the final circle is typically heavy industry and logistics parks. Sandwiched between that resi and the heavy industry and logistics parks, you'll find airports, seaports, and hubs for high-speed rail links. Within each band, you'll notice that there's a distinct real estate topology that is single use. An office is an office, a warehouse is a warehouse, and a multifamily residential building is just that. My view is that almost all future real estate will need to be designed to be mixed use and flexi space, allowing them to be repurposed as needs dictate and evolve. Just like we're seeing now malls in the US being converted to logistics space and data centers. Of course, the first few steps of repurposing real estate will be painful and annoying. Multifamily residents will find themselves sharing their address with a cloud kitchen, a last mile delivery warehouse, and a public access electric vehicle charging station in their parking structure. As zoning laws catch up, things will get smoother. With that, my prediction for the next 10 years in changing real estate is that the big nucleus of cities will dissolve into multiple clusters of mixed-use assets.
That's fascinating. That's really fascinating. One final question before I let you go. In all your years of investing, tell us about one time you failed and what you learned from the experience.
I have a very long list of these, but continue to be blessed with partners on the one hand and business leaders at NBK Capital on the other hand, who adopt the growth mindset, who are forgiving and extremely supportive. Let me try to abstract one of those so it's somehow useful to our listeners. A few years ago, Yasser and I were attending a conference in Bahrain where Mohamed Ali was speaking. He was closing with some advice for the audience. In perfect sync, both of us began typing out the note on our phones. Let me read it out to you. His advice was to have and build 1, resilience, 2, optionality, and 3, agility. It was a second that really resonated with me and continues to do so. We operate in markets in the region that are shallow and volatile. The moment you see yourself depending on a single investor to seed or close your fund, a single deal to achieve your deployment target, or a single bank term sheet to leverage your deal, you're in the danger zone. Pause and put plan B into motion. In every situation, you're not your counterparty's only option. So you should also create and have more than one option or path to achieving your own desired outcome.
Thank you, Mohammed, for doing this. I really appreciate you taking the time.
Thank you, Suraj, for inviting me. It's been a privilege, and I hope that this has been useful to our listeners.